Hey, good morning, everybody. This is Brett Vargo here at the corporate office in San Diego, and it's a lovely, sunny, summer Southern California day. I appreciate those of you on the call who are attending today's FHA Streamline training. This is a training that that we did at the beginning of June, and in the past 6 weeks or so since FHA Streamline guidelines changed slightly, we have seen quite a few of our investors make changes on their end as well. So I thought it would be nice and necessary to have an updated training, and also for the benefit of those of you who have joined the company in the meantime. So we're going to go over today some basics of the FHA Streamline program. It is definitely a very viable option for us right now. There's a lot of these loans available for us to refinance. So let's jump into it and go into FHA land. Okay, first of all, a basic program overview. So the FHA Streamline, it's a HUD program designed for borrowers currently in FHA loans and, very importantly, already making their payments. The main intent of the program is to lower the borrower's monthly payment, and do so because, of course, remember, they're already making their payments, already have a solid mortgage history on their existing FHA, so they will reduce documentation and qualification requirements. Now, what we're going to talk about today is really non-credit qualifying streamlines without appraisals. Those are really what we're going after right now. HUD is still offering credit qualifying streamlines, which are necessary in some cases. They're also offering streamlines with appraisals, which honestly I don't really see much of a point. So we'll talk about the credit qualifying streamlines a little bit towards the end of the training. But again, remember, when we're going through these slides, we're really focusing on the non-credit qual streamlines without appraisals. Just a few of the benefits. So of course, yeah, no appraisal required, as you could guess. We have no income verification. No income is listed on the 1003, and hence, of course, no DTI qualifications. Now, of course, the caveat I have to make here is that I'm going to be presenting some general HUD guidelines, and we'll talk about some investor overlays. But keep in mind that investor overlays rule here. So all guidelines that we go over will be subject to our investors' whims. Just some basic documentation requirements on the FHA Streamline. First of all, the HUD case number. We're going to go over how to input the case number and reflect it as a streamline after this slide. The refinance authorization. This is going to be very important to tell us, what our MIP refund is, etc., what our current balance is, and what our value is being predicated upon. Our 92900 LT, that's our standard FHA underwriting transmittal. Of course, our 1003, our 92900A, the addendum to the 1003. Important to get a copy of the note on the existing lien. Our payoff statement for the month of closing. Keep in mind, beware of when these payoff statements expire. If we have to go to the next month, chances are we'll need a new payoff statement. Their current mortgage statement so we can see their payment breakdown. Net tangible benefit worksheet, and we will go over that in a little bit as well. The refinance worksheet. Asset verification. Now, it's important to note that on this product, traditionally the FHA Streamline has been a no asset verified program. However, over the last couple years, they have tweaked their guidelines a bit to where closing costs can no longer be built into a Streamline loan amount. If the borrower needs to bring any funds into the table to close, we're going to have to verify those assets. Credit report, and that's going to vary based on our investors. Some may only go with a mortgage rating and credit scores, but most will want to see a full RMCR. Just like pretty much every loan now, LDP and GSA, which we will be running through our Fraud Guard suite. Social Security number identification and validation. Of course, any other applicable FHA forms and disclosures that we would get on any other FHA loan. And again, this is a basic list. May not be all-inclusive based on the specific investor that the loan's going to. So I'm actually going to jump off of this slide presentation, and we're going to go out to FHA Connection. We're going to take a look at our HUD case number and how to pull a refi authorization. I will make the assumption that everybody on this call knows how to get to FHA Connection. If you don't, please hit me up after this call and I can walk you through that. From our main homepage, of course, we will sign on. Looks like I'm already signed in. We're going to go to our single-family FHA, single-family origination, case processing, case number assignment. Same thing we would do ordering a case number on any other FHA. I'm going to go ahead and plug in my property just in case anybody wants to send Christmas cards, hate mail, whatever. And no, not, I trust you all, but I'm not going to put in my real social. Of course, I am going to put in my real birthday. Yeah, I was born in 1990. Sure. Click our certification box. All right, and now we are to our case number assignment field. This is going to work the same as any other case. Plug in our originator ID, etc. We won't go through all these fields. But here's where it gets different. Under our, make sure to mark 203B. Nothing applies there. Under our type of case, we're going to specify it as a forward refinance. So down here, if refinance, specify the type of refinance. We're going to come down here on an FHA Streamline, has to be a prior FHA loan. We're going to come down here, all refinances. We're going to select our Streamline refinance type. And we're talking about Streamlines without appraisal here, so we'll select that. It is not a cash out refi. And we're going to want to put in the prior FHA case number. So you should be able to get that off of their previous note, off their mortgage statement, or you can do a case query in FHA Connection to get that. So you plug that number in. Now, on your initial case number, when they return it, it should have your refinance authorization down at the bottom based off of this old case number. So it'll tell you what the original value was, which we're going to use for most investors as the value for the new loan. The other thing we're going to want to do on a Streamline is down here under the projected closing date. Typically going to be the end of the month. And what we're going to tell it to do here is on our refinance authorization, we are going to get a netting authorization broken out for 2 months. So for our projected closing date and then the month after that, just in case it spills into the next month. If we go past that, or for whatever reason your refi authorization doesn't show up on your case number assignment, we're going to go in and we're going to print a refinance authorization separately. And to do that, we're going to go back into case processing, and we are going to come down here to refinance authorization, and all we're going to do is we're going to plug in our current FHA case number, not the previous, our projected closing date. So if we're closing at the end of August, we'll throw in that date, your contact name and phone number, and it will pull up the netting authorization. And we're going to hop back over to the slides. And next, so here's what our netting authorization is going to look like. So you will see, well, hopefully you can see it's pretty tiny and maybe a little illegible, but it will have our unearned MIP, so that will be their MIP refund, as well as we have this field broken out here, original property value, which you will see is very important for determining our LTV. All right, going back a slide. So as far as our mortgage amount is concerned, used to be that on an FHA Streamline, you could do a credit qualifying stream and build in closing costs into the loan amount. Well, that is not the case anymore. So on a Streamline, we are going to be looking at the principal balance on the existing first, and that may include interest charged by the lender if the payoff is not received by the first of the month. So, up to 30 days interest on that, but it may not include any delinquent interest, any late charges, any escrow shortages, nothing like that. Just the principal balance and interest just in case they don't receive the payoff by the first. So we're going to take that, we're going to subtract out that MIP refund. Now, if the refund is larger than the new MIP being charged, and you're going to see in just a moment that based on when the loan we're paying off was endorsed, the new upfront MIP is going to be very low. So you may find that in most cases on these older loans that we're paying off, it is going to be the lesser of the two, which is the new upfront MIP. And then we're going to add back the new upfront MIP. So again, closing costs, you cannot include them in the loan amount, which means they either have to be paid in cash by the borrower at closing or through an interest rate credit. So if you have enough credit to cover all those costs, great. At the time of the origination and the loan approval, every bit of documentation should reflect no cash back. This is not a cash out product. Just in case you have any, any differences in your costs, any little adjustments, they can receive at closing up to $500 back. Now, if we exceed that, we're unfortunately kind of at the mercy of our investor as to whether they will allow a principal reduction or anything like that. So my suggestion is, well, don't do it. I mean, if it looks like on our estimated HUD that we're getting more than $500 cash back, then we're going to have to tweak things a little bit. Typically, of course, HUD will only do owner-occupied properties. On a Streamline, you may run into a situation where the borrower purchased the property as an owner-occupied, and then they are now renting it out as an investment. So HUD does make an exception, again subject to investor overlays, to streamline those properties. However, they can only be streamlined for the amount of the outstanding principal balance. They may not include any interest in that loan amount. And then also the new base loan amount, and we're talking about before our upfront MIP, cannot exceed HUD's county limits. There's a link here in this presentation, and this presentation is on the intranet if you want to go in there and mess around, play with the links, etc. I should say on this last point, on the statutory county limits, you really probably won't run into this, but if you have a county where, let's say, the loan limits now are lower than they were when the original loan was taken out, there may be an exception to exceed the county limits in order to streamline that loan. So our LTV and CLTV, we are typically going to take the value from our refi authorization. So again, over here, we're going to see the original property value for the loan we're paying off. In this case, in this example, $355. That is what we're going to use for, I believe, all of our investors except one. And that's how we're going to determine our LTV and CLTV. Now, LTV really is subject to investor overlays, but typically for HUD is not really an issue. These are borrowers that are already making their mortgage payments. They've already paid into the MIP system, and they are strictly bettering their position. Now, if they have existing secondary financing, it may be subordinated. HUD's guideline is a max 125% CLTV if they are subordinating an existing second. Now, the calculation's a little funky because HUD's definition of CLTV is going to be based on the original first base loan amount before upfront MIP, plus the max accessible credit limit on the second. So again, if we're doing a HELOC, we're going to be looking at the max credit limit as opposed to the balance, and then divided by the original property value. Reason why FHA streams are such a big buzz right now is HUD has recently changed the upfront mortgage insurance premium and the annual mortgage insurance rate. In most cases, they've gone up, as I'm sure we're all aware. For case numbers, and keep in mind it is based on when the case number was assigned. If it was assigned on or after June 11th of this year, your upfront MIP across the board is going to be 1.75, 1 3/4. That's regardless of loan size or LTV or terms. And then your annual MIP, which of course is prorated out monthly, is going to be predicated on your base loan amount and your LTV, and then whether you're over 15 years or at a loan term of 15 years or below. Well, that's all very fine and dandy, but they came out with this nice little provision for streamlines if we're paying off an FHA loan that was endorsed on or before May 31st, 2009, which you may notice is the same date that Fannie and Freddie put in place for HARP loans. So they're saying if you're paying off one of these old dogs, we are going to, on the new loan, reduce the upfront MIP to 0.01%. Crikey, that's low. So in other words, for a $100,000 loan, that's $10. The annual MIP is going to 0.55%, 55 basis points, which some of you may remember was actually the old annual MIP amount, I believe, at that time, around 2009. So really their annual MIP should stay about the same as it is right now. So that creates a huge refi opportunity for us, which is why we're starting to push these so much. Now, on a streamline, we have to make sure that there is a benefit to the borrower, and that is our net tangible benefit. The standard, here's this table here tells us the loan they're coming out of and then what they're going into. So let's say your standard fixed rate going to a new fixed rate. We want to see a minimum 5% reduction in the principal and interest plus their monthly MIP. So that's the main one to remember. Now, you do have some different calculations here. If they are going, let's say, from a 1-year ARM currently, and they're going to a 5/1 hybrid ARM, they want to make sure that the new interest rate is at least 2% lower than the current rate, which would probably be during the ARM period. So, just be aware of the borrower's current situation and what kind of tangible benefit they have to meet on the new loan. Now, a little note down here, a reduction in loan term is not a net tangible benefit in and of itself. They still have to meet these criteria. So if they're going from a 30-year and they want to go into a new 15-year, we say, oh, well, they're shortening the term of their mortgage. That's a benefit. Well, maybe, but doesn't count in HUD's eyes. They still would have to meet a 5% reduction in their P&I and monthly MIP. Now I'm going to pop out of these slides again. And I was hoping I had this up. Bear with me. I created a few months ago an FHA net tangible benefit worksheet, and this is also in the intranet in the forms section. And this is designed to help you guys determine very easily whether they meet the net tangible benefit. So you see we have our benefit test up here. If it's fixed to fixed, here's what we need to meet, 5% reduction. So you're going to plug in the current payment. Going to plug in their current MIP, making up numbers, and then you're going to plug in their proposed on the new loan. So you see, in this case, we have a 9% reduction in the monthly payment, and we get a nice pass. So, I'd probably go ahead and do this and include it with the file so the underwriter can see that you've done your homework. Now let's tweak this a little bit. Let's say our proposed P&I is $19.50. Well, now we're only saving a little over 2%, and we have a big fail. Hence, we could not do a streamline in this case. So again, on the internet, use that to your benefit to make things easy. On all streamlines, it is required that we have seasoning on the lien we're paying off as of the date of the case number assignment. Again, it's important to make that distinction that we're talking about the date that the case number is assigned, not the date that our new loan is closing. So we have to meet all of the following seasoning criteria. Have to make sure that the mortgage owner has made at least 6 payments on the mortgage being refied, and we have at least 6 full months since the first payment due date. So they did that basically to prevent people from making 2 payments in a month and then trying to refi after 3 months. And we have to make sure that we have at least 210 days since the closing date. So we're going to look at our example here. Bill Vapor closed his loan on December 31st, 2011, which means he had a first payment due date of 2/1/2012. So we're going to take our closing date, we're going to tack on 210 days, which brings us to July 28th, coming up pretty soon here. And our first payment due date was 2/1/2012, so 6 months from that point is 8/1/2012. So we are going to go with, since we have to meet all of these criteria, we're going to go with the latest date. So therefore, oops, that wasn't supposed to happen. Therefore, we cannot order that case number until after August 1st. As far as payment history, HUD is allowing this streamline for borrowers that have shown an acceptable payment history. So we want to make sure that we have a solid 12-month history. If they have held the existing mortgage for less than 12 months, we have to make sure that all payments have been made in the month due, so no late. If they have more than a 12-month history, we're just going to do a 12-month look back. HUD's guidelines are that the borrower may have no more than one 30-day late. Keep in mind, we're going to be talking about investor overlays a little bit on. Most of our investors are going to want to see no 30-day lates in the last 12 months. Even if they had a mortgage late, the last 3 months have to be clean. No lates. And then no 60 or 90-day lates. If they have anything exceeding that in the last 12 months, can't do it. As far as credit history, HUD does not require that we verify credit outside the mortgage history. Now, we as a company, we're requiring a full credit report. That's how lender's office works. That's how our relationships with our credit vendors are set up. The minimum credit score is going to vary. We'll go over that in a little bit. And typically, other liabilities, adverse credit items will not be taken into consideration. They're really concerned with the mortgage history, and our investors are, going to look at the overall credit score. Let's see if there are any questions. Let's see. We have one. May I get a copy of the PowerPoint being used in training? Yes, the PowerPoint will be available. It actually is already available on the internet. I guess lucky for me, this is being recorded, and we will post this up on the YouTube training channel after a little bit of judicious editing like all these dumb asides. All right, so eligibility. The term of our new loan is going to be limited to either the lesser of 30 years or the remaining term on our mortgage plus 12 years. So for example, let's say that they have 15 years remaining on their loan right now. All right, lesser of 30 years or the remaining term plus 12 years. Remaining term 15 plus 12, 27. That would really be a 25-year term for HUD, so they would be limited to a 25-year loan. From an underwriting perspective, these are manual underwrites only. Do not use, HUD does not want us to use total scorecard through DU or LP. Income verification, it's not required. We're not going to put income on the 1003. We have a couple of investors that will require lender certification that the borrower had a source of income at the time of application. Sometimes that's just a lender cert. Sometimes they want to see, let's say for example, the borrower is receiving Social Security. They may want to see an award letter just to verify the source of that income. And a 4506T is still going to be signed with the disclosures and docs, but it will not be executed. Again, we will not verify income. Employment verification, we do require that we have the employment stated on the 1003, and we will do a VOE, a verbal VOE, to make sure that they are employed at the time of closing. And we talked about asset verification, only required if we need funds to close. If they're covering all closing costs with an interest rate credit, not bringing any money into the table, they don't have to verify those assets. Condo approval. Typically, of course, on a HUD loan, we are going to want to make sure that the condo project is HUD approved. On a Streamline, condo projects are typically eligible on Streamlines without appraisals if they were once on the list and are now withdrawn or expired. And that comes down to a D underwriter investor comfort level too. If the project was removed for some sort of litigation, construction defect, something like that, you know, they may overrule on that. Adding borrowers to title, you can add a borrower to a Streamline, no problem. The existing borrower has already been making the payments, we know that. Adding another borrower is only going to strengthen the deal. Deleting borrowers is where it gets a little tricky. General rule of thumb, borrowers cannot be deleted on a Streamline. There are several exceptions to that rule where that may happen. One is in the case of an assumption. We're talking about an assumption that occurred more than 6 months ago. It didn't trigger the due on sale clause on the note, and we need to show that the person that assumed the mortgage has been making the payments for at least the last 6 months. Another example of when this may be acceptable is if we have like a quick claim for divorce where it's happened more than 6 months ago and the remaining owner-occupant can show that they've been making the mortgage payments. There may be other deletions allowed on a case-by-case basis if they're doing a credit qualifying Streamline. But generally, adding borrowers okay, deleting borrowers not so much. And we're going to take a look at some of our investor overlays, and this is really, you know, what's changed more than anything since we last did this training in June. You know, after the MIP schedules changed and everybody was going after this book of business, well, investors started getting a little skittish, thinking, well, wow, this you know, really increases our risk. You know, we don't know if there is anything fraudulated on the previous loan. We're not, you know, really verifying anything. So, you know, we started to see some investors come out with various overlays. So I'm going to go over this chart a bit. Currently, we have on the correspondent side, you know, 6 good outlets for these: Flagstar, Franklin American, Puff, PennyMac, Plaza, U.S. Bank. The only one on the LTV that is really concerned with meeting any sort of LTV limits is PennyMac, and they are at 115%. Now, the difference with PennyMac, as opposed to all of our other investors, is where most of our investors will take that value off of the refinance authorization that we looked at before. So they'll go off the original property value. PennyMac, however, wants an AVM run through CoreLogic. And I think I got all the processors, their CoreLogic AVM passwords. If you need one still, let me know and I can knock that out for you. They're going to take the value off of that CoreLogic AVM and max it out at 115%. Furthermore, on PennyMac, if your LTV is over 100%, or CLTV if you're subordinating a second, they're going to require, it's going to come back on the AVM with a score. And they want that score to be 14 or below. So just beware of that little quirk on PennyMac on the value. Everybody else, they're just going to go off the original value of the property. They don't really have any stringent LTV calculations. For CLTV, if we're subordinating an existing second, beware of the investor overlays. Flagstar will go to the full boat 125, but Franklin, for example, will only go to 100. Plaza will only go to 100. PennyMac, 115. Credit scores, HUD is not concerned with credit scores. Our investors are concerned with credit scores. So beware of what we can do with various investors. Some will have some stipulations, such as Flagstar, where they have a credit score of 680, but if the existing loan is serviced by Flagstar, they'll allow you to go to 640. Franklin bases it on loan amount. If you're under conforming limits of 417, you can go to 640. Anything above that, 680. PUF actually does not have a credit score requirement on these streamlines. They will actually accept a mortgage report only with no scores. I put 580 on here because our warehouse lender requires a minimum 580 score. I did talk to them because we had a loan that fell into this scenario where the borrowers did not have a score. We were able to get a mortgage rating but no score. That is actually acceptable. But if we have a credit score below 580, it won't fly. PennyMac, they're going to base it on the LTV. Anything with an LTV or CLTV below 100 or at or below 100, 640, and anything above 100, 660. Now, they require only one score. Now, we're going to require that we pull all three bureaus, but if only one returns a score, that is acceptable for PennyMac guidelines. Plaza 660, and then U.S. Bank, kind of the same thing as Franklin, where they base it on loan size, 660 below 417, 680 above 417. Now, U.S. Bank, I'll tell you right now, probably not going to be your best option because they recently came out around the middle of June stating that they will only do a streamline if the current mortgage is held by U.S. Bank. Credit history, you know, most everybody, just general rule of thumb, does not want to see any mortgage lates in the last 12 months with a couple of exceptions. Flagstar will allow up to 1 30-day late. Last 12 months, they'll follow HUD guides. PUF will follow HUD guides. U.S. Bank will follow HUD guides. So as we talked about, 1 30 days is okay as long as they've made their payments in the last 3 months. A few little quirks on value. Like I said, most everybody is taking our value off the refinance authorization with the exception of PennyMac. Flagstar has a little quirk for properties previously listed for sale. If the LTV is above 70, they want to make sure they've been off the market for at least 3 months. But, you know, just so beware of little quirks there. Just some other little things to be aware of on Flagstar. They will only do owner-occupied. If it is now a second home or non-owner, they won't touch it. Franklin, they require the source of income to be supported, not necessarily the income itself. So, for example, verbal VOE if it's W-2 earner, business license if it's self-employed, award letter if it's Social Security income. And they do not like investment properties. PennyMac does not want any borrowers deleted unless there is a death involved, and then they will not do non-owners as well. Plaza, keep in mind we are not delegated, and they will only do owner-occ. And then, like I just said, U.S. Bank will only allow if the existing mortgage is a U.S. Bank-held loan. So keep in mind, this is as of right now. I'm providing this for information. I'm going to, give you the full disclaimer that these things are subject to change at any given notice, and we have seen that over the past month. Of course, always recommend PML is a great tool to determine what investors you are eligible for. A couple things to watch out for when you're in Price My Loan. Make sure that your loan purpose is changed to FHA Streamline Refi. You will get different findings if you leave it as a rate and term. If it's credit qualifying, you will mark that box. We will seldom have credit qualifying streamlines. Outstanding principal balance, you will take that off of your refinance authorization. Your upfront MIP refund, again, you will get that off of your refinance authorization. Dropping down to your loan amount calculator, make sure if you're doing a Streamline without an appraisal that the appraisal yes box is not checked. Then down here, your original appraised value, take that off of your netting authorization as we saw. And that's it for PML. Now when you're setting the loan up in the lender's office, a couple things that are specific to a Streamline. When you're setting up a template, make sure to select the FHA refi template that corresponds to your branch. Keep in mind, too, that we are offering a fee special on Streamlines as well right now. I believe $895 total. I can't remember the exact breakdown on that. On the This Loan Info screen, for loan purpose, make sure you have FHA Streamline refi checked. Going to the upfront MIP and funding fee screen, we set up templates a certain way. We actually set them up based on the worst case scenario. So for example, we have them set up, I believe they could even be set up at 1 3/4 to account for the worst case upfront MIP. So you will want to change that based on your loan scenario. For example, if the loan we're paying off closed before May 1st or May 31st, 2009, you're going to change that total upfront to 0.001. If the upfront MIP is being financed into the loan, make sure to click yes. If they're paying it in cash, click no. On your FHA transmittal summary screen, this box here, hopefully you can see that. I know it's kind of tiny, but you'll see under loan purpose that we have a choice for Streamline refinance and mark without appraisal, assuming you are doing it without an appraisal. Okay, that pretty much wraps up the non-credit qual without appraisal, and it looks like we have a question, can they get a gift for funds to close? You know, I'm at a disadvantage without having an underwriter in here for these questions, but they can get a gift to close. We would then need to verify those gift funds. All right, credit qualifying Streamline. Few instances where you may have to credit qualify. And when we talk about credit qualifying, we are talking about verification of the borrower's income, verification of their full credit history, and a calculation of ratios. Now, credit qualifying Streamline must be considered when we have a change in the mortgage term that's going to result in a payment increase more than 20%. So again, non-credit qualifying, we're going to want to meet our net tangible benefit. Credit qualifying, if we're changing the mortgage term, let's say a 30 to a 15, and the payment goes up by more than 20%, you can still Streamline, but have to credit qualify. If you're deleting a borrower and you meet one of those rare exceptions, but it triggers the due on sale clause, you have to do a credit qualifying Streamline. If there is an assumption of the previous mortgage and it occurred less than 6 months ago, or it does not trigger it does not contain a due on sale clause that limits the assumption only to a creditworthy borrower, then we'll have to credit qualify. Okay, some resources for you. If you pull this presentation, these links are all live. Log on to FHA Connection. If you need to order case numbers and you do not have access, go to this website, and there is a user registration form on there. Typically within 24 hours, it will send me an email as the FHA Connection admin. I'll get you set up for the access that you need. Your 4155. This is like the Bible for FHA guidelines. This is the lender handbook, underwriting handbook, whatever you want to call it. Of course, investor guidelines always rule, but this will give you a good idea of HUD's guides. Another great resource at HUD that I didn't put on here, but probably should, is the HUD FAQ. If you guys want to write this down, if you don't already have it, it's www.hud.gov/answers. It is a phenomenal site. You type in a question, you can search by a keyword, and it will bring up a lot of answers for you. So it's a great resource. Your HUD mortgage limits, you go there, you plug in. Actually, I'm going to click over there. And we'll let it spin, and we'll go on to the next. Okay, there we go. When you are looking up HUD limits, you can limit it if you want to limit it by a certain state. Let's say, for example, California. If you want to limit it by a certain county, you can do that. For HUD limits, make sure that you have FHA Forward in here, because you can actually also pull up conforming loan limits from this site. For your limit year, make sure it's 2012 so you're pulling the most current data. Click Send, and it will break it down by county and tell you your limits for a single family, duplex, 3-unit, 4-unit. So that's a good resource there. And then, of course, for internal support, we have our underwriting questions hotline available. uwquestions@iservelending.com goes to a few of our high-level underwriters. Comes to me, Mike Wilson, the regional managers, Ken Michael and Alan Friedman. So, somebody on there is going to have your answer and get back to you in a timely fashion. Open up, see if there are any questions. Looks like we have a couple of questions. So we don't enter any income amount or show any debts on the application. That is correct. You do not have to show any liabilities other than the mortgage that we're paying off and any subordinate financing, and you do not have to show any income on there. Will our comp structure change on these cases? Currently, I don't believe that it does. Check with your regional manager on that, but I believe that your comp structure is in place across the board. Okay. Well, I want to thank everybody for your attendance. I'm actually going to stop the recording now so we don't have a lot of dead space, but I will stay on for a few moments just in case anybody has any additional questions. And if you don't, feel free to jump off. Hit me up either directly, bvargo@iservelending.com, as a part of the Vapor team, vapor@iservelending.com, or at UW Questions. Thank you all for attending, and have a wonderful day and great weekend.